If you're not having fun doing it, then you're doing it wrong. We're going to have a great time. We have a phenomenal discussion going to be happening here. Donnie, do you want to kick it off with any words in the beginning here, or what's your MO?
Emma, well, I just want to say thank you to the Institute for agreeing to do this for us. It's been something we've talked about for a while, and Jimmy and I met up at Apex and SEMA, and I said, hey, how about we do a session, because we've got members who've had some really interesting things happen to their businesses. And I told them, let's call this thing "How to Lose Your Business in 2 Minutes," and they're like, maybe we better not do that. Uh, so I thank you guys for doing this for everybody, and everybody that showed up to listen. So I'm gonna turn it over to you and just listen in.
Nice. Awesome. Well, thank you for being here, and thank you for meeting up at the conference. That was super awesome. We caught each other there in the, I think it was in the elevator, the escalator. We were coming down, and Donnie says, hey, we really want to do this webinar about, we got to help our shops and our companies and our businesses and our members. They're losing their business. They're operating dangerously. And I said, oh, so you want something around the lines of how to protect your home? How do you not lose your home in 30 seconds? Because there's so many businesses out there that are operating without the protection of a corporation. And that's what we're going to talk about here today is essential steps to save your home and save your business. Joining me today in our webinar is Wayne Marshall. Wayne is with the Institute. We're excited to have him here with us as our interim CEO. Thank you for being here.
Jim?
Yep, and everybody who's aware, Cecil Bullard has been through some surgery. He is in recovery. He's doing extremely well. He's been into the office twice now, and it was only a week and a day ago that he had some brain surgery. So that is one resilient man. Pretty amazing. This is to be an interactive webinar in that we want to know what you're thinking. We want to know your questions. You've got questions. We've got the answers. We're going to talk a lot today about corporations and incorporating and how to do it, why to do it. What are some great ways to do that? Because this is going to help to protect you. And that's what we want to do here, is to be able to protect you. So Wayne, we brought in Wayne. Wayne, I have your slide deck here. So when you give me the signal, we'll make it happen.
But so, yes, you can go back.
Got it.
So it's an honor to be here, because when you stop and look at, you can look at the statistics too, that come from the Department of Labor. 95% of all businesses that are in our country operating today do $3 million and less in revenue. So when they say the small businessman is the backbone,
oh, it totally is.
It really is. But when you look at this and you start thinking about how small businesses start and grow and they get going, many of them do start just as we see in our industry.
Oh, yeah.
As a small mom and pop, might be one person, two people, and eventually they start to grow and they start to increase those revenues. But it becomes really critical and very important whenever you get started, that you start doing things and you build the right foundation, so that when you get ready to take some of those next steps and you start to add an employee, or you might say, I want to have my own facility or own building or property, that you make those moves that put you in the right position legally.
Yeah.
That gives you the right things you want, but also that you start giving some forethought to the right moves you want to make. So you put yourself in the right place taxable, because like me, I don't want to pay any more tax than I need to. And there's things you do when you start thinking about that corporate structure that can and will make a difference. And we're going to point out a few of those things for consideration. And also, hopefully, through some of this, we'll be able to look at this. It gives us some of that scalability.
Yeah.
Of where we begin, starting small, but giving us the opportunity to go and get it up to that bigger level that we want to get into.
Yeah, we want to grow the business. We want to be protected by the business. We want to protect you on the business as well. And for those of you who are in the audience, you're listening to this live, the Q&A in the bottom section of your window for the Zoom in the Q&A. That's where you want to put in your questions. And just to make sure that this works for everybody, I want to give you a shout out. Go to the Q&A and type in where you're joining us from today. If you want to put the name of your shop, your business, your mobile business, city and state, would love to give you a shout out. I want to make sure that this Q&A is working. So if you're listening, yes, we do want you to type that in there. Virginia, got Bruna from Virginia, Kyle from Crystal River, Florida. Oh, you guys are awesome. John from East Ohio, Lawrence in New Jersey. Rock on. Thank you so much, you guys. Yes, it is definitely working now. Jacob Bell from J-Tech Automotive Solutions, Tucson, Arizona. Jacob, welcome. Glad to have you here with us. Jeff from St. Paul, Minnesota, and Jeremy from Columbia, Kentucky. You guys rock. Thank you so much for being here. Thank you for participating. You've got questions. We've got some answers. We've got a lot of really great information to help protect you, help protect your home, help protect your future retirement, your future of everything.
Benefits.
Because you don't want to lose everything because of a mistake, an accident. And the way to do that is to protect yourself.
So let's jump to this first slide. Many people are very familiar with the different structures that come in.
Pull your mic a little closer.
Is that a little better?
Yeah, Richard's saying can't quite hear. And this is Wayne Marshall. I know you think it's Cecil. Cecil had surgery a week ago. This is Wayne. Richard, no, Jeff. Jeff, can you hear Richard better? I mean, Richard, can you hear Marshall better? How's that? Michael, we good? Okay, rock on.
So let's jump to that first slide that we talked about. Most people are very familiar with some of the different structures that are out there. And most people in the small businesses are taking advantage of just putting together an LLC. And we all are familiar with, within that LLC, there's a lot you can do. But on top of an LLC, you can also do an S Corp, which is a sole proprietorship, or ultimately you can have a C Corp. C Corps are usually regulated to more of your larger companies and the things you're going to do. And what I've always done, I've had and started and sold many businesses in my career, and I've done every one of those as an LLC. And one of the things that's really great about that LLC is we're saying at the very top, it gives you limited personal liability. It becomes that firewall and that shield from you and your personal, your home, your savings, all the other things to what you're doing on a business. So those debts and those things that are going on there cannot transfer over and affect you on a personal level. And that's what you want to do, because you never know when something happens, especially when you get a little larger and you might have an employee or something else could go on within those that can affect your company. And that limits you from having anything cross over into your home or putting it at risk. It also gives you a lot of tax flexibility that you can pick how you want to do your taxability of the income and the money that you can make on that. If you're in an LLC, you can choose to file as a business, as that LLC. You can choose to file as a sole proprietorship or, the S Corp, and you can even choose in an LLC to be incorporated and file taxes as if you were a C Corp. Obviously, you want to probably stay to where it's the most easiest, and we'll talk a little bit about, and I've got a few key things that we'll be sharing as we get into it. The other thing that's nice about an LLC is there's less formality or compliance requirements that you come into. If you take a C Corp as an example, many of your large corporations are C Corp. There's a tax ability of it that's higher than what you're going to get as a personal business owner. And the other thing of it is that you're going to have much more structure. In a lot of cases, even the requirement to create shareholder board meetings and other things that can come into play. One of the other things that's really nice about once you start forming your legal corporation or your LLC is you enhance your overall credibility, but you bring legal protection. So think about what you're doing, and you don't want to be sitting there and have your business finances commingling with your personal finances. If you create an LLC, you're going to get a tax EIN number. You take that EIN number, you can go to your bank. You can then create that bank account. You don't commingle your monies, you keep it separate, which again keeps you in that credibility and legal protection, because you can start talking about and how you're going to receive in the handling of those funds. And then the last thing that we talk about is very flexible ownership and management. Just because you start the LLC, you can have what they call a manager managed LLC. Someone else can manage it. Someone else can run it for you as you get bigger and you say, I don't want to sell my business, but I want someone else maybe to run it now. And you can have a manager run the LLC that you still own. And it gives you that flexibility where obviously when you get into some of the other S and Cs, you don't get all that flexibility and there's much more compliance that you have to deal with. So those are some of the key benefits of, and the most and biggest is number one, you want to create that firewall. You want to separate your business life, business money, all the things that go on from your home. So you don't get into a litigious situation where someone can tie it all together. You can say, nope, everything stops with the LLC.
Yeah. Do you know of any situations where someone was operating as a sole proprietor and they got into a sticky situation? Do you know any of those situations?
Most people that I have seen, yes, I do.
Yeah.
And most people who have not filed and done, they end up in a tax scenario. And the IRS, they get kind of funny with their money and they think they always got to have it. And if you don't keep those two things separated, which comes down to some of the things that we're talking about in number 4 and 5, where you got that flexibility, you get credibility, you get the bank account set up right. You can keep those things where they don't look at it in a funny way.
Yeah.
So because he never separated out and he just kept running everything through him as a person under his social security number, because you don't have a tax number of an EIN
Right.
of the business. So now it's got to go to your social security. Yeah, he ended up about 400,000 in arrears with the IRS.
Oh boy.
Lost his house, lost everything because he didn't have the firewall.
Oh boy.
So they don't like that.
No, they don't like that. They don't like that at all.
That's probably one of the more extreme cases.
Yeah, that would be an extreme case. But that's also what can happen if you're not
That is
set up
correct.
right.
That is correct.
Okay.
Very much correct. So let's jump into, if you want, we can jump to some of the tax benefits. I did share, and I know this slide is a little bit busier than the other, but the first thing and one of the biggest benefits of the LLC is that you have pass-through taxation. And what happens is if you're a C Corp, as an example, you have to pay a 21% corporate tax, but then you got to pay tax again on the income that you make. So you end up paying tax on it twice.
Right.
And if it's just passed through, there is no business tax. It only passes through you and then it comes back to your personal taxes when you file, where you'll be getting your K-1 or other things. And if you work with any of your local accounting professional or tax preparer, they can help you work through these things. That can help you do, but it helps you on your taxing standpoint, which is a good thing to have. The other thing is obviously you can have we talked about it earlier a little bit, was very flexible tax classifications. And then you can decide. Most people, once they get into an LLC, they keep it down to a sole proprietorship or partnership.
Right.
If you bring someone in and they don't do anything with an S or a C, even though you could, but you want to avoid that because of the taxable aspect of what you're going to get. And you can get into a lower tax bracket,
Right.
which you want to keep. Obviously, as soon as you become an LLC, there's a lot you can start running through that becomes a deductible business expense. So many of us people, and I did it, many do, you start thinking of having a company vehicle.
Yeah.
Other activities that go on. You maybe need a new computer or laptop. Sure. Am I going to use it at home? Yes. Am I going to use it for business? Yes. I'm going to use it as a business deduction. And there's other things that can come into play that helps because now that becomes a deductible expense. You don't have to pay tax.
Because it's a business expense.
Because it's a business expense that you can come into.
Yeah.
Obviously, there's a self-employment tax savings. There's things that can come into play here that really becomes nice under the LLC.
Okay.
And I know we tell a lot as I coach people also, we tell them this a lot that pay yourself a reasonable salary.
As an owner,
but take that additional profits at distribution, because if it's a W-2 income, that's taxed at one rate.
Yeah.
Dividends or profits, if you do a distribution or an earning payment out, that's at a lower tax rate. So as you start to go up, and if you get to a point, like as we tell some of our coaching clients, Jimmy, is we get to a certain point that I tell people, if you're going to pay yourself about 90,000, talk to your tax professional. Don't exceed that. Talk to them about doing dividends. If you're having a really good year,
Yeah.
pull it out as dividends because it's taxed at a lower rate and it won't take you to the next tax bracket.
Nice.
So it's a way to also help save money and not give it to the IRS, keep more of it in your pocket and or reinvest in your company. The other things that have happened here in the last few years is there's been some different things that have passed legislatively that, and again, those tax professionals can help. You get into the qualified business income deduction along with some of the Tax Cuts and Job Acts that can help qualify you for a one-time 20% deduction on
Yeah.
different income because they're trying to help the small business person keep the money so they can reinvest. Because again, I go back to 95% of all small businesses are what we have in the United States. That is the backbone. And the more that we can put in their pockets, the government's saying, that's more reinvestment that helps them bring more money back to the IRS eventually because they're helping to grow the economy.
Yeah.
And that's a significant tax savings too to give.
I think there's a misnomer or a misconception within the industry that says, I, as a company owner, as the corporation owner, I can't take a paycheck. Is that true?
No. You want it, like we said, you want to be really mindful of how much you take
Right.
that can put you into a higher taxable event than if you keep it lower. And it'd be no different. I mean, as small business people, we start to grow, and I started in rented space in some of my companies. Eventually, I got to a point, I said, instead of paying rent, I'd rather own and let it help pay for the mortgage and create more wealth.
Right.
And change my overall net worth because now I have commercial property that I've bought. So again, I started another LLC that owns the property that I then now pay to them out of the first LLC, the company. And now there's other things you can do that helps because I can also pay extra to the property LLC, and the IRS, for the most part, if you're paying an extra 15% above what the going rate is for a lease, you can put that in a maintenance fund.
Sure.
It's not taxed
For the cams.
for
Yeah.
the cams, but it's not taxed. So now you got more cash sitting there that's giving you the opportunity to do other things and reinvest and do things within your property or other stuff. So again, a good tax preparer, a good accountant can help you navigate these waters, but it's so important to start and have those right business entities.
Yes.
Get them legal, get the LLC, get your EIN, keep your money separated, your personal and business. Don't commingle, that can create you issues, but you can start to create and it'll improve your overall net worth and build it.
What advice would you give the shop owner or the business owner that currently is commingling their funds?
You're hurting yourself.
Yeah.
So think about it this way. And I talked to one of our coaching clients and I'm looking at his P&Ls and we're talking. And one of the things he's trying to do is increase the overall value of his company. He wants to, in the next 3 to 5 years, sell his company. Any good person that's going to come in and do their due diligence or the discipline to look at the financials is going to go back to 3 years. Well, we're going through it. And I said, well, wait a minute, gentlemen, on this. I won't say his name. But I said, I see $13,000 that was spent at Walmart. And he goes, well, yeah, that's my groceries. That's this, that's that. And I said, okay, I get it. And you can do that. And there's some gray area.
Sure.
But here's what it meant. And I explained to him, I said, okay, so you spent $13,000 this year. And if we go in the rears 3 years and you do that every year, so that's 13, that's 26, that's 39,000, let's say $40,000.
Okay.
And you're trying to sell the company and you want to get 3X or 4X on your EBITDA. That was $40,000 that you used in personal. That was really profit for the company. Take that 40,000 now times 3X EBITDA. That's $120,000 less you're going to get when you sell your company.
Ouch.
And all of a sudden he's like, yeah, I'm not gaining anything by
Yeah.
doing it through the company. I
Yeah.
said, you're not.
No, clean up your finances.
Don't mingle them together because where it can hurt you, especially if you're trying to get to a point that you want to sell your company,
Yeah.
you don't want any of those personal expenses because that's going to make the company not look as profitable. And that might help you today in taxes, but that $13,000 is going to end up costing him 120,000 or
Yeah.
more, 160 if he got 4X on his EBITDA. So that is why you want to be really careful
Yeah.
about how much of some fringe personal things.
Yeah.
And you can do it.
Right.
You're not going to get in trouble with the IRS unless you get really aggressive on it.
Right.
But if you're thinking you're going to be in a position to sell, or you're going to bring a partner in that maybe wants to buy into your business, you want to look the best you can look.
Yeah.
And you want to maximize those bottom line earnings. And that's where it's hurting you. And that's where it can really multiply up big.
So at what point do you start the process that says, hey, you know what, I'm ready to sell my business now? Should we start today with that process, or do you start
If
2
you
years
think you're
down the
gonna,
road?
I tell everybody that we talk to with our clients, if you think you're going to want to sell your business and you tell me I'm going to do it in the next year, we can do a few things, but we're not going to move the needle much.
Yeah.
You need almost a minimum of 3 years to really clean it
Yeah.
and make year after year after year look good. Because when they look, they're going to take those 3-year numbers, they're going to average it out, and that's where your multiplier is going to come from.
Oh, for sure. I hear it said all the time that 3 to 5 years.
Yeah.
3 to 5 years is what it takes. But really and truly, you should start today.
Yeah.
I started my business
Good
yesterday.
habit. Just a
Good.
good habit.
Start today and build that habit.
Yeah.
Okay, good.
Yeah. So one of the things, I don't know, I think we had some questions or anything here that we should stop and talk about?
Let's see if we have any cute questions yet.
I've seen
No,
a couple things pop up.
nope, no questions yet.
All right. Just want to make sure. Because I see on the screen here and I see something pop and I'm like, oh,
Oh,
no
no.
big deal. One of the things that we get asked, and it's like one of our coaching clients right now that we're working with Jimmy is he's going from a C corp and he's moving it over to an S corp. And a lot of this is because of the taxation aspect of, and he's also in a position, just as we talked about, that he's trying to get ready to sell his business.
Right.
And transfer out. And he's trying to maximize his income. And with a C corp, you're limited on what you can take out of it. And obviously it's going to be just on your W-2. If you get into an S, or you get into some of the things we're already talking about, where you got flexibility, he can get more cash out in earnings in the short term. That will help maximize and then also put him in a better position, because most companies, unless you're a large company, and when I say large, I'm talking 50, 100 million and more, you don't want to be a C corp. And it's going to limit his possibilities of selling without restructuring his company. So he's in the process of doing it. So one of the things we get into conversations with him here recently, which I wanted to share a little bit more, which is on that next slide, is which is right for you. And again, it's like he's doing, we started talking about these things, but at the end of the day, I says, again, your accountant knows better what should be done, how to do it. They know your personal situation. But one of the best things, again, if you're just in a default LLC taxation, you can see what happens when you sit there with the pass through, and especially when you're a self-employed, you're at a 15.3 tax. That's a lot lower than what's going to be on a W-2.
Oh yeah, for
and
sure.
Those are some of the benefits that you get when you start looking at this thing with your profit pass through on your personal taxes and some of the things you can do with the earnings. And it's perfect for that small business owner without employees for most part. Even though if you got 1 or 2 employees, it's the perfect place to be.
So that single member LLC.
Yep. Keep it simple. Keep it simple. And like I said, there's the benefits of, if you go to and you start getting employees, you start making more money, you do other things, then you want to start maybe looking at filing as an S corp.
Okay.
Or sole proprietorship. Then there's also partnerships you can look at, and we'll talk a little bit about. But what you can start doing here, especially if you think your earnings are going to be over 60,000 in the course of a year, you have that ability, which I was talking about earlier. If you can take so much as income and then take another portion of it as a distribution or an earning or a dividend,
yeah,
people will talk about, that's going to put you in some of your best spots
Right.
to maximize what you get in income and put cash in pocket compared to how much you're going to end up paying in taxes. And that will reduce your self-employment tax again. There are some things you got to do, obviously, to set up payroll, which I mentioned here. You're going to have to file in Form 2553 with the IRS because you got employees. There's going to be other things that got to be done around that. But again, it's about keeping your tax bill low, keeping the money in your pocket so you can reinvest. Everybody's got a unique situation. So I know I say it multiple times. Talk to your tax preparer, talk to your professional accountant, ask these questions.
Yeah.
Ask what's best for me. I think this year, take 2025, I'm having a really good year. I
Yeah.
think I might make $120,000. They're going to say, that's great to know because here's what we're going to do.
Oh,
We're
nice.
going to do this. We're going to do this. Take this much in distribution, pay this much in your quarterlies off that distribution, what have you, and it'll put you at the right spot at the end of the year, minimizing that exposure.
Beautiful. Now, speaking of talking to your tax professionals, the question came up, what is an EBITDA?
Oh, EBITDA is earnings before interest, taxes, and amortization.
Right. So what does that mean?
So you got your earnings
Yes.
that we all know, which comes to your bottom line.
Right.
And then before interest, if you got interest loans that you're paying, which is a deductible, and then you got taxes you got to pay. And then if you take that depreciable asset, amortization of it as it's going down, because all of those are different things that write off that change what the net is.
Okay.
That adds
So
to it.
is the EBITDA, and these are questions coming in, is EBITDA the same as net profit?
It depends on how your books are set, but yes, they can be.
Pretty dang close.
Pretty dang close.
Yes.
But usually when you get into your EBITDA, so you're taking so if people are using QuickBooks and you get your QuickBooks set up and you can run all the different categories and you got all your different things you're set up. You got income, you got expenses, then you got some of those miscellaneous things, and then you got earnings. This money that's left over. Some of the things, unless your accountant has gone into QuickBooks and set up your depreciation schedule, you're not going to get to the EBITDA at your net. So it will change some. If you've got, so if you had a property LLC, you're going to have big amortization of your building because you're paying a lot in interest. And you got a lot of that that's flowing through. So it can change the bottom a lot. But usually most small business people, what they've got, they've got a vehicle, which isn't overly, I mean, they're expensive, but they're not over the top like a building. It might be a lift, or like for us, a lift, an alignment rack, some of those things.
Right.
You're going to put it into a depreciation schedule. You're going to amortize it out over time. But there are some things which many people are familiar with. You can do accelerated depreciation. There's other things you can do. Again, a good preparer can tell you when you should take it and when you shouldn't.
Right.
And when we want to schedule it out, or we want to just go ahead and take it all in the first year and just be done.
Nice. Beautiful.
Just depends on how much money you're making.
Oh yeah, for sure. Okay. So one more question here about the LLCs. You talked about a manager to run your business.
Manager managed LLC. They call it. Yeah.
So you said as an LLC, you could have a manager run your business. Could you review again, what are the tax or overall benefits of doing it that way, of having a manager run your LLC?
There's not really anything on a tax because it's still going to flow through.
Correct.
Just because I started the LLC and maybe I'm saying, you know what, I'm going to still work, but I'm tired. I'm going to have Jimmy as my manager managed LLC. I can put him on the legal papers. He can get all the legal docs, do all the things that need to be done with IRS and so on and so forth. And he's got that power and authority that you're going to have in your operating agreement. But I still have to take care of all the taxes and the things that are being done. Now, if I'm an LLC, and one of the things we talked about was flexibility of how we can pay, I can pay Jimmy however I want to pay him and not worry about certain things. Where if I was very structured, like a C Corp, you got shareholders, it's very structured and everybody's paid, whatever. So as an example, if we were in a C Corp, we owned it 50-50, we'd have to split the earnings in half.
Oh, wow.
But if he's here, let's just say you're still 50-50. I'm not doing squat. I can pay Jimmy 90% of the earnings. I can do anything I want to do under the LLC. You can't do that in a C Corp.
Right.
It's very rigid based on the shares and the percentage and
Right.
so on and so forth.
So I think a lot of the members here for NASTIF are mom and pop shops, mom and pop structures, mom and pop business. Pop is out as the technician. He's either working on cars, popping locks, working on vehicles. He's in the shop. Mom's up at the front. She's doing the books. She's doing the counters.
Right.
So in those situations, what is a good LLC for a mom and pop structure business?
Let's get into some other things that could come into, obviously, trust and wills and other
Yes.
things that could be considered with obviously transferring of.
Yes.
Now, most people, and I'm not trying to take a deep dive into the legal language of, but most people, when you sit there and you'll hear about setting up a corporation, you've got articles of incorporation or you're going to have an operating agreement. They're very similar. It's not just how people define them. There's really not a big difference. But part of all those agreements will also have in there certain things under buy sell, things that how you would transfer, what happens upon death of a partner or an owner in. If you have a husband, wife, I can give you a strong argument because you've created the right firewall to put both on. If you want to do some things that put you in favor with female owned or whatever, maybe make the wife 51, 49, just to keep that as you want to do. But in that, we'll also have some of the structure about the passing of others, which you can then say, how does that affect the outstanding stock, which can easily then, if you create the right trust, that everything can move into the trust. And again, a good legal professional can help do. But because the one thing is, one of my businesses, I had 4 partners, great guys, but I told every one of them, I says, I don't want to be a partner with your wife.
Right.
So if something happens to you, we're going to write in there that upon your passing, your shares go into a holding state. You have no voting right. You don't have anything, but we're going to take care of your wife correctly. We're going to do the valuations and we're going to buy her out and give her the money that she should have. As an example.
Yeah.
But I don't want any of your wives jumping in actively to the business, not trying to be a jerk, but
no. And when my dad had his business with his partner, he had a death benefit, a key employee benefit. So if you got a mom and pop situation and mom was to pass away or dad was to pass away,
right,
you can have a life insurance policy on that person.
That is correct.
It comes to the business.
And again, which I did that. We did that too. So we did, the company bought, we did it instead of a key man policy with obviously death benefit. We did it in a combo with an annuity. So it was a way to, and again, talk to a professional on, but there's a way to structure this that we were buying the death benefit if something happened.
Right.
We were the beneficiaries. We got the money and then gave the money to the spouse because that bought the shares. So they still benefit.
It's perfect.
But the other thing we did, what if he doesn't die? So what we did is we started putting the money into an annuity with the death benefit, which the policies are there. We're paying more and we're getting a return which happened. None of us did die, fortunately, never had to deal with. But the beauty of it was when we sold the company, every one of those annuities came back to us and it became deferred income.
Oh, that's beautiful.
And it was a way, and again, you got to talk to a person to get it set up right.
Yeah.
That you can do it to keep the tax ramifications out.
Right.
But it ended up being that we were putting not a ton of money, but we were putting about $10,000 in each. So pretty soon we got up there and before you know it, it's worth $100,000. It's multiplying in value. Right. And growing off the annuity that's giving a return.
Oh, that's beautiful.
Instead of money just going away. Yeah, I needed a death benefit, but we also made it to where it had value that each of us got to benefit with basically a deferred payment.
Nice.
Of income.
So nice. Excellent.
Small little thing to get.
All right. So one more last question on the S Corp before we go past this one. Questions coming in that says, under the S Corp, is there a benefit of establishing a home office? And this person, you may need to type in a little bit more to expand on this idea. Does this mean you have brick and mortar and you're establishing also a home office, or you're working solely from your home office and want an S Corp, which I have that?
Yeah. So you can do again, it's like anything in life. There was 20, 30 years ago, people were abusing this privilege with the IRS code. And there was a lot of audits happening from
Mm.
people I know because they, all of a sudden they were putting their dog on as part of their expense because it was a watchdog.
Oh gosh.
I mean, people
This
do
is
crazy,
security.
yeah, no, people do crazy things and then they wonder why they get audited.
Yeah.
And so the things I would say, because look, I do it. I got a home office.
Right.
You've seen, you know,
Yeah.
where my home office is. And so, yeah, I take a percentage of, and I can take a percentage of electricity, water, internet, all the things that I need to run my office. It's part of my tax,
Yeah.
you know, deduction and write-off that I'm doing. You just got to be careful. Don't take advantage of the code. But yeah, you can do it. Again, your tax preparer, if you tell them how many square feet based on all these things, they can add it up. They've got the
There's
formulas.
a formula that they
Got the
use.
formulas that they can use to help you get and stay clean with the IRS.
Beautiful.
But yeah, do it. Might not be a lot, but hey, $400 or $500 is $400 or $500.
It all adds up.
Amen.
All right. Well, good. So are we going on to
Yep.
3?
Let's go on to the next. So, I mean, the last other one that we've got is obviously C Corp. No one's going to do it. I just threw it up here just so you can kind of see
So everybody knows it's
and
available. Yeah.
why C Corps really suck unless you're big, because you can see it has a flat corporate tax rate of 21%. And then if you get a dividend, you got to pay tax on it over again. So the
Mm.
company's paying tax. You then get a dividend of what's left, and you got to pay a personal tax on it again, along with the tax that was coming out of your paycheck on a W-2. And it's a very complex, and there's a lot of formalities and garbage that nobody wants to do. The only reason that people choose this is if they're starting to really grow and you want to attract investors, you want to have obviously scale. And there are companies I know, a few years ago, I consulted with a company over in Illinois. Yeah, they did convert, but they were 55 million, privately held. They were growing and they were wanting to get to 100 million. When we got to 100 million, they were going to go to a public offering, a small one.
Nice.
And that's the reason you do that stuff, because it gives you structure and governance
Yeah.
that allows you to do. But
So
I
it's
just throw it out
there.
there
It's
just for
available.
fun.
Yeah.
for
It's
fun.
probably past what we're doing.
Yeah.
All right.
Obviously, the best things that we get into when you get all done, when you look at corporations, is obviously you can deduct everything, take advantage of retirement plans, other things that could come out of. You can use different tax credits and things for the hiring of people. You know, you got to look at what state you're in. There's things around. Some states have no income tax. You know, you look at Nevada where you live.
Yeah.
Florida doesn't. There's other things that you
Wyoming.
consider. Yep. Other things that you want to look at in there. At the end of the day, it's like we talked. It really comes back to looking at your own personal situation, the size, how much money you're going to make, how big do you want to get. Talk to your professionals. Most everybody's doing that, and they're putting together the different things with their tax preparers to help them. Ask those questions. Say, I'm going to have one heck of a year. What should I do? How should I prepare? And try to have those conversations early in the year.
Yeah.
If you get to the beginning of July or you get to that third quarter, if you've paid obviously you paid your quarterly estimates based on what your income's going to be at that point. If it looks like it's going bigger and stronger and your tax preparer's already given you your coupons, go back to them and say, look, I'm having one heck of a year. How can I manage this to minimize my tax exposure? Should I change what my income is on my income or payroll, W-2?
Yes.
Should I change dividends?
Yes.
Should I leave the money in?
Right.
How does that? Because again, it's going to pass through. And we talked about the 15% tax rate for businesses. It's, up on the LLC at the top at the beginning of all this. So yeah, just have those conversations. And the goal here today, more than anything, was just to have these conversations that you ask good questions when you sit down, and that you start talking about, here's what I got going on. Here's what I'm doing. Here's what I want to do. Here's how I want to set it up. They'll help you. It's just asking those questions.
Yeah. And I think that's what we're really empowering everybody here with, is the knowledge, the information to be able to ask those right questions. Yeah.
Yeah.
knowledge is power, but knowledge is also dangerous, especially if you think you know the right way to do it. And then you discover, oh, holy crap, I did it totally wrong.
Nobody wants those, oh crap moments at the end of the year.
Yeah.
Or it's happened to me because I didn't do a few years back. Yeah. You're sitting there and all of a sudden your tax preparer is going, yeah, we kind of missed the mark and you're going to have to write a check for $20,000.
Yeah. No,
Those
thanks. Yeah.
Or I've had the other side a few years back. I'm sitting down and I didn't do a good job. And he goes, you overpaid and you're going to get a refund for $40,000.
Oh, wow.
And I'm going, you know what I could have done with that money if I had it every month and invested it or did other things?
Oh,
but
yeah.
I let the government held on to my $40-some thousand
Yeah.
dollars.
And did you get any interest on that 40,000?
I got zip. Zippo.
Ouch. All right.
So I think I have one last slide that just says, hey, here's some things to consider. Obviously, we talked about different states and certain states who have, well, some states have franchise taxes or annual fees. Don't live in California or New York. I apologize for any of you that are on us that are in those states, but they're not business friendly. And obviously some states are more business friendly, but hey, real easy. If you got a low income business, just stay with your LLC taxation, do the Schedule C. It's easy. If you're starting to get up to moderate or higher, and that's 60,000 or more, consider the S Corp and some of the things, because it gives you flexibility of income and distribution on a quarterly basis. And God bless you guys, if someone gets big and they're going to franchise them,
hallelujah. Let's
become
go.
a C Corp.
Yeah.
Call Jimmy and I. We want to invest.
We
want to make money too.
At what point does it make sense to go to a C Corp? Is that based on the number of employees? Is that based on the number of locations? It's all dollars.
Yeah.
Dollars driven.
Yeah. If you start getting really big and you get multiple shareholders, or you want to go public, and do other things. Yeah. I mean, you look at some of the bigger companies today, and if you go back and look at their history, they started out like we started out. I mean, you hear the stories of, well, Apple and Microsoft started in garages, and now look at them today. But there was a point where they said, we're going to go and we're going to become a C Corp because we're going to get shareholders. We're going to do this. We're going to have shareholder meetings, all the other things that come with it.
Mm-hmm.
But we want to be big. And when you get that size, you don't care about 21% of what the corporate tax is, because the revenue is so high and so big.
Yeah. Oh, that's phenomenal.
So
knowledge and information, so powerful. Questions, comments, concerns? Would love to address any of those other additional questions that you might have. Maybe there's something that's sticking out in your mind that, hey, you know what? Well, what about this situation? What about my situation? I'm a small mobile tech. I'm doing 6,000 a month. What kind of a LLC should I have? There's a question for you. How about that?
I'd keep it simple.
Just the simple LLC.
I would do the simple one. If it's just you and you're self-employed and you're running your business well, keep it simple like that. If you're having a really big year, because I know some guys who are running an independent one-person business, they're making 6 figures plus, then you need to start doing some planning.
So that's when you start looking at the S Corp?
Yep. Even if it's multiples, because your income's getting so high.
Yeah.
And I didn't look it up. I should have real quick, but I know in 2025, it's somewhere around $96,000 or $98,000. You go to the next tax bracket.
Right.
So, this is, again, where a good tax preparer is going to tell you, look, we want to look at this, pull this. And like our coaching clients, our coaching clients, as we talk, I tell them, if you want to pay yourself, because, and then see how your dividends are going, your earnings are going, start at about 90. If you want to go higher, that's fine. But again, talk to your preparer, start at 90, take those paychecks out, and then look at what you're going to do with dividends or earnings on a quarterly basis.
Yeah. Yeah. We do know a couple of shops that are single employee, the owner, and the owner is the phone, the computer, the wrench.
Yep.
And they're doing in the $400,000 a year range.
I'm coaching with one.
Yeah.
And he's trying to get his company in a position to sell.
So is he currently as an LLC looking to go to S Corp, or does he just, because he's looking to sell, he's probably.
So he was doing exactly what we talked about when I started the whole conversation. He was an LLC for his business. he owns the building personally. And I'm like, dude, you've got to get an LLC for your business or the building, the property. And then you need to pay yourself rent and then pay yourself a little extra rent because that generates a little extra income. We talked all this through. So he got it done at the end of the year. So he started this year, 2025, a clean tax year. So he now has a property LLC. So if he sells his business, he can now create income off renting his business, his building back out. So that can be ongoing retirement income for him and his family as he wants to go as an example. He could also turn around, sell the business, put that on a 5-year balloon, sell the building separate of and create a different income stream.
Love
And it
it.
changes some of those tax ramifications because the other thing you got to start looking at and then plan for, even on a business, if the valuation goes up, there's still capital gains. And you also have capital gains, as we're all familiar with, on property.
Yeah.
So again, and it's same as he's done, and I keep saying, but he talked to his local preparer and I said, here's the things you want to ask. Here's some of the questions we want to address that get you set right for your personal situation.
Love it.
Excuse me.
No, some questions coming in from Jeff, and Jeff, thank you. This is a really good question. The S corp breaks at $60,000. Is that $60,000 of profit, or is that $60,000 of business revenue after the owner gets paid? What is that $60,000?
So if you're going to make 60,000 in profit or net, so let's just say for sake of argument, you did 400,000 in revenue, you
Yep.
paid yourself 80,000,
Okay.
and the company still made over 60,000, that's where that would kick in.
Oh, I see.
So even if you want to look at it because it's going to flow to you on a sole proprietorship and that pass through, it's going to show that you really made 140 or more thousand, maybe 150,000. But that's when you want to stop and say, okay, if I pay this and I'm at this tax level, I don't want to get to some of the next tier that starts to happen when you get over the 96, 98, you get to 100. I can't remember where the next one is off the top of my head, but it's like 120 something. And then it just continues and you're just going to pay more. So this is again where you want to stop and go, okay, I want to have my taxable income here during the year so I don't overpay, and then take dividends and other earnings that you can, or you can leave it in and then talk about how you can reinvest in other things you can do with it. But that's how that all adds up.
Nice.
So it's not your income separate of the 60.
Beautiful. Beautiful. Jeff, I hope that helps you out, brother. Cool. Good. Well, we're asking for final questions, comments, concerns.
No, hour went by fast.
It's like a flash, man. And I'm thinking of a client that we have in Texas. This is a shop that was struck by lightning, flooded, and caught on fire.
Yeah.
Yeah. And lucky for them that they were covered. They did have the right insurances in place. It's not even something that we're talking about today, but it is important. You do need to evaluate that. And there's been a lot of businesses that when they start, they have 2 bays. They have an insurance policy for 2 bays. Then they grow and they grow and they grow. And then there's a problem. And now that insurance policy that they set up originally doesn't cover 4 bays, 6 bays, 8 bays. And then they get into a little bit of trouble. So lucky for this shop in Texas, they had all the right insurances in place, that they were covered. And the trifecta within, I think it was within 2 or 3 weeks that they got struck by lightning, caught on fire, and flooded.
Another thing, I should have said this earlier too, but one thing, if you start going down this road, if you don't do one, I do one annually, have done them for years when I had my businesses, even still to this day, I do them. Do an annual personal financial statement.
Nice.
That list out all your debts, all your assets, the valuation of your business, everything else that you're sitting there and you can see what your net worth is and how that net worth is changing year
after year
to year, because it's a great scorecard to just look at your overall, not only your personal financial health, but to even look at it from a bigger picture of your business and how everything is changing and growing. Because any of us as business owners, we work our butts off at times. And you sometimes wonder, am I really gaining? Am I getting what I should get? And it was always a nice thing to look at. And I try to sit down, and then my wife and I would talk about it. And I'd say, you know what? This is paying off. Sometimes it doesn't feel like it because you're just like,
You're in the
running.
grind. You're in the
yeah, you're
grind.
grinding it out. But when we would take the time and look and see that, but wait a minute, I did add this much to my 401k or my IRA or something. I did do this. We do pay down the building more that we were owning. We did this things. And next thing you know, you just start seeing that growth and you're seeing that change. And then you look at 5 years ago to there and you're going, oh my goodness, we are doing it well and we are making a difference in what we're trying to do today. So it's just a good exercise. I know I've shared some things with the form I've used. I've sent out to others that I've coached with. And I say, it's just one of those things to just, it's a good way to see, am I going up or down? Am I winning, losing, and and what's my overall health? That's what you're really trying to do. That's why we do what we do.
Yeah.
And that's why we got into business for ourselves.
Oh, so true. So true.
So
Question from Jeremy. He's asking, when you pay yourself, do you deduct taxes? And I think there's two answers to this question.
is.
Yeah, go ahead.
So if it's W-2, so it's an actual payroll.
Payroll.
So when you think about all the normal employee deductions that you would have, Social Security, what have you, yes, I would run that, and I'd run it actually through with, QuickBooks can do it if you're just a single person and you're using QuickBooks. It can help you get and deduct the right things and make all the right payments that you need to pay. And then the second is if you pull it out as earnings, yes, that's where your tax preparer, if you guys kind of remember, you're going to get a coupon. It'll be for the 4 quarters of, you need to write a check to cover your dividend tax or what you're going to take on earnings, or what the earnings of the company might be, even if you don't take them out. So you don't end up with a tax surprise at the end of the year. Hence, I had to pay 20 grand because I didn't pay enough.
Ouch.
Quarterlies going through, and then you got to pay it at the end of the year. So yes, my normal W-2, yeah, normal taxes, everything, you run it as you normally would. The others are done quarterly on a coupon.
Oh, I love it. I love it. So big compliment to you from Jason. Jason says, right? Well, what did we do this time? Jason says, thank you so much. I now understand it so much better than when my accountant tried to explain it.
Wow.
LLCs, S Corps, C Corps.
Thanks.
Yeah, good job, brother.
Appreciate that.
Thank you, Jason. Yeah. All right. One more thing. And this goes from, first is from Jeff. Jeff is saying, does Wayne offer coaching services?
Yeah,
Yeah. As a matter of fact, we do.
there it is.
Matter of fact, we do. If you find this information interesting and inviting and educational, and that's really what we're here to try and provide
Yes.
for you, is an education, information, knowledge. If you find it interesting, let's have a meeting. Let's see
Yeah, let's
if
reach out.
coaching would be something of value to your business. Are you at a position that you're ready to do it? I know of a mobile shop in Virginia that wanted to come on with the Institute, and he just wasn't ready, It took him about a
Yep.
year. And after a year, saw him again at a show, and he's like, yep, I'm ready. Let's go. Went from doing $6,000 a month as a mobile tech to his first month brick and mortar, $24,000 that month. And started day one with coaching and training to make sure that he was doing it right. So big shout out to our friends there in Virginia.
Well, that's no different than a guy, you met him, our guy from Canada. He started out with a mobile truck.
Yeah.
Truck mechanic.
Yeah.
And today he's got 3 mobile trucks in a 22 bay shop. He's gotten huge.
That is huge. 22 bays.
Each mobile, and we've talked about it, and we're working with him today and working on some things. But yeah, he talks about starting on that mobile truck to the point today, each mobile truck for him, because he also does heavy earth moving equipment and construction equipment and service, along with over the road diesel trucks. Each mobile truck's running about 400,000 in revenue.
Wow.
So he's getting $1.2 million between his 3 mobile trucks, not counting all the stuff comes to the shop on 22 bays.
Gotta love that. Gotta love
Started with
that.
1 mobile truck.
Yeah.
And there he is today.
There is.
Great story. Great story.
So those of you who are interested, scan that QR code, first name, last name, email address. Let's set up an appointment. We can sit down and review your business, review where you are. There's no obligation. There's no financial cost to it. So that's a free resource for you. As well, check out our website, wearetheinstitute.com. Wearetheinstitute.com. A lot of valuable information on the website as well. Our YouTube channel. There's easily over 160 hours worth of knowledge and information that you could gain a master's degree in running your shop, your business, your mobile business. That's going to help you as a business owner. Available on YouTube, and that's a free resource as well. Any things that you would want to include in an offer that we can send to our listeners that are on this webinar today? Maybe the 5 steps to a 20% net profit. Maybe a couple links to some videos that we've.
There you go. Sure.
Yeah.
Let's make it happen, Captain.
Okay. Well, scan the QR code and make sure you, as you talk to our representatives, you say, Jimmy told me that you were going to send me the workbook, 5% net, 5 steps to a 20% net profit. 5 steps to a 20% net profit. And there's a webinar that goes right along with that where Cecil breaks down those steps and exactly what you need to do every step along the way. So with that, thank you very much. Appreciate the time. Wayne, thank you to you, brother. Appreciate it. Great knowledge, information. You got another shout out here. It went away. Let me get to it real quickly because Jeremy says, thank you guys. This has been a real eye-opening experience.
Awesome.
Lots of great information. Definitely going to make some changes. So Jeremy, to you, thank you very much, brother.
Glad to help. Love paying it forward.
Yep. That's what we do.
All right.
And with that, we'll see you again soon. Thank you.